Shanghai opens tonight, and before a single trade is placed, before Western markets even blink, China's largest silver recycling firm, one of the biggest scrap buyers in the entire country, has already put real cash on the table, $96 per ounce, on a day when Shanghai itself was still closed. That is not a rumor. That is not a forecast. That is a business, making a live cash offer for physical silver at a price the Western markets haven't even imagined yet. So ask yourself one question. If China is already paying $96 for silver before the market even opens, what happens tonight when Shanghai finally does? Welcome back to Currency Archive, where we don't chase headlines. We read what's happening before the headlines are even written. Now, if you've been around long enough in life, you know that the early phone call is never good news, and the early signal in silver is always worth picking up. So if you haven't subscribed yet, do yourself a favor, the same way you'd remind an old friend to lock the door before leaving the house. Hit that subscribe button, because the next move in silver, you don't want to miss it. And before we go further, drop in the comments right now, where in the world are you watching from tonight? Because this market is moving, and I want to know who's watching. On a Monday morning, while most of the financial world was still sleeping, a transaction took place. Not on a trading floor, not on a screen filled with flashing numbers, not in a boardroom surrounded by analysts in expensive suits. It happened quietly, deliberately, and almost completely out of sight. China's largest silver recycling firm, one of the biggest physical scrap buyers in the entire country, placed a real cash offer on the table. They were willing to buy back 99.99 pure silver at $95 to $96 per ounce on a day when Shanghai was still closed. Let that settle for a moment. Because this was not a futures contract. This was not a speculative position. This was not a number on a screen that disappears the moment someone clicks away. This was a business, a real operating business, offering real money for real silver at a price that the Western world had not even come close to printing yet, and almost nobody was talking about it. Do you understand why this moment matters? One must first understand how silver pricing actually works, and more importantly, how it can be manipulated through silence. The Western world prices silver primarily through COMEX, the commodity exchange in New York. This is where futures contracts are traded, where paper silver changes hands in enormous volumes, and where the headline spot price that most people see on their phones is generated every single day. But here is what most people do not know. COMEX trades paper. It trades promises. It trades contracts that say silver will be delivered, not silver that is sitting in a vault ready to move. The overwhelming majority of COMEX contracts are never settled in physical metal. They are rolled over, canceled, or closed before delivery ever becomes a reality. China operates differently. Shanghai's silver market, the Shanghai Futures Exchange, is far more connected to physical reality. When Chinese businesses buy silver, they are largely buying metal they intend to use in factories, in solar panels, in electronics, in industrial applications that cannot be satisfied by a piece of paper saying silver exists somewhere. This is the fundamental divide that most Western investors never fully appreciate. And it is precisely this divide that makes Monday's cash offer so significant. When a recycling firm, whose entire business model depends on acquiring physical silver at the right price and reselling it into the industrial supply chain, offers $96 per ounce on a day when the Western spot price was sitting near $86. Something is being communicated. These are not gamblers. These are not speculators making emotional bets. These are operators, professionals who have spent years in this market, who understand supply chains, who know what real physical silver costs to acquire, process, and deliver. They do not overpay, unless they believe they are not overpaying at all. Unless they believe that the price they are offering today is actually the price that the market will confirm tomorrow. Here is where the story becomes impossible to ignore. Shanghai had been closed for the Lunar New Year holiday. While Eastern markets slept, Western prices moved. Silver climbed, gold climbed. The financial landscape that Shanghai would wake up to was meaningfully different from the one it had left behind before the holiday began. And into that silence, into that gap between what China knew and what Western markets had not yet processed, this recycling firm placed its offer. $95 to $96, cash, physical, real. Not a forecast, not a prediction, not an analyst's target written in a research report that no one reads. A business decision, made with real money, by people who cannot afford to be wrong. The question that every serious observer should be asking right now is not whether this offer was real. It was real. The question is what it means. Because when the largest physical buyers in the world's largest silver-consuming nation start paying $10 above Western spot price, on a day when their own exchange is not even open, they're not confused about the price. They are telling you what the price is about to become. There's a game being played in the silver market. It has been played for decades. Most people never see it. Not because it is hidden in the shadows, not because it requires a security clearance to understand, but because it is hidden in plain sight, buried inside the very structure of how silver is priced, traded, and controlled in the Western world. And right now, that structure is beginning to crack. Imagine two stores selling the exact same product. One store is located in New York. It sells receipts. Beautiful, official-looking receipts that say, in very professional language, that the buyer owns a certain amount of silver. The receipt is tradable. It is accepted everywhere. Institutions hold it. Pension funds hold it. Banks hold it. Governments recognize it. But if someone walks in and asks to take the actual product home, the store gets uncomfortable. Delays happen. Fees appear. Paperwork multiplies. And in many cases, the silver that was supposed to be sitting in a vault somewhere turns out to be considerably more difficult to locate than the receipt suggested. The other store is located in Shanghai. It sells silver. Actual silver. Metal that moves through supply chains, enters factories, gets pressed into solar panels, soldered into circuit boards, and built into the infrastructure of a modern industrial economy. When Shanghai's buyers place an order, they're not collecting receipts. They're collecting metal. This is not a minor distinction. This is the entire story. The Western pricing system, built around COMEX futures in New York, was designed in an era when American industrial demand for silver was dominant. It made sense at the time. The United States was the center of global manufacturing. American businesses needed silver. American exchanges priced it. The world followed. That era is over. Today, China consumes more silver than any other nation on Earth. Its solar industry alone has rewritten global demand projections in ways that analysts are still struggling to fully calculate. Its electronics sector, its electric vehicle supply chain, its military and aerospace applications, all of them run on silver, real silver, physical silver. And yet, the price of silver is still being set in New York, on an exchange where the overwhelming majority of contracts never result in a single ounce of physical metal changing hands. This is the disconnect. This is the architecture. And once a serious observer understands it fully, the Monday cash offer from China's scrap buyer stops looking like an anomaly. It starts looking like a correction. History has recorded this pattern before, and it has never ended quietly. In the months before silver's historic run in 2011, Eastern physical premiums began quietly climbing above Western paper prices. The arbitrage was visible to those who knew where to look. Scrap buyers in Asia were paying above spot. Refineries were reporting longer lead times. Industrial users were placing forward orders at prices that seemed aggressive by Western standards. Then Western markets caught up. Silver moved from $18 to nearly $50 in a matter of months, not because of a rumor, not because of a single news event, but because the physical reality that Eastern markets had already priced in finally forced itself onto the Western paper markets that had been ignoring it. The gap always closes. It has never not closed. The only variable is timing. Now consider what the Monday cash offer is actually saying through this historical lens. A business that lives and dies by the accuracy of its price assessments, a recycling firm that must buy physical silver, process it, and resell it into an industrial supply chain at a profit, decided that $96 per ounce was a rational price to pay, while Western spot sat at $86. That is a $10 gap. In silver terms, a $10 gap between what the physical market is willing to pay and what the paper market is currently printing is not a rounding error. It is a verdict. Eastern buyers are not confused about the value of silver. They are not emotional. They are not speculating on a headline. They are running a calculation, the same calculation they run every single day. And that calculation is telling them that $86 is not the real price. 96 is closer to reality. And Shanghai hasn't even opened yet. Because here is what makes this particular moment structurally different from ordinary price premiums. Shanghai was closed. The Lunar New Year holiday had taken the world's most physically connected silver exchange offline for an extended period. During that silence, Western prices moved. The gap between where Shanghai last traded and where it would reopen had already grown significantly before a single Chinese trader had placed a single order. That gap needed to be filled. And China's scrap buyers, the professionals who cannot afford to wait for Western analysts to catch up, were already filling it in cash at $96 before the opening bell. What the Western market has not yet fully processed is not a technical detail or a footnote buried in a commodity report. It is a structural message being delivered in the clearest language that markets know. Not words, not forecasts, not commentary, money, moving. Now. And when Shanghai opens tonight, the world will find out very quickly whether the paper price in New York, they do not come with headlines. They do not come with warnings broadcast across television screens or urgent notifications pushed to mobile phones. They do not give the average observer enough time to process what is happening before the move has already been made. They arrive quietly, and then, all at once, they arrive violently. Tonight could be one of those moments. To understand what Shanghai's reopening represents, one must first understand what an extended market closure actually does to price pressure. Think of it this way. Imagine a river that has been dammed. Water continues to flow from its source. Rain falls, tributaries feed in, the pressure builds, but the dam holds everything back. The surface on one side looks calm, controlled, manageable. But on the other side of that dam, the pressure has been accumulating the entire time. The moment the dam opens, the water does not trickle through. It surges. Shanghai's closure during the Lunar New Year holiday was that dam. Western markets continued to move during the holiday. Silver climbed, gold climbed, geopolitical tensions shifted. Institutional positioning changed. The entire financial landscape evolved, while Shanghai sat completely offline, unable to respond, unable to adjust, unable to reflect any of it in its pricing. Tonight, that dam opens, and the pressure that has been building on the other side has nowhere to go except forward. The mechanics of what happens next are not complicated, but they are consequential. When Shanghai reopens after an extended closure into a market that has moved significantly higher, one of two things tends to occur. The first possibility is a controlled catch-up. Shanghai opens higher, gradually absorbs the Western price movement, and the two markets find equilibrium over several sessions without dramatic disruption. This is the outcome that paper traders in New York are quietly hoping for. The second possibility is a gap-up open. Shanghai opens sharply higher, not gradually, not gently, but with the kind of aggressive upward movement that signals genuine physical demand meeting a market that has been suppressed below its real clearing price. In this scenario, the opening itself becomes the catalyst. It triggers a cascade. Western futures traders watching Shanghai gap up begin repricing their own positions immediately. Algorithms respond. Institutional desks adjust. And the move that began in Shanghai at midnight ripples across every silver market on the planet before most Western investors have finished their morning coffee. History overwhelmingly favors the second scenario when the conditions match what exists tonight. Now overlay the technical structure that currently exists in Western markets. Silver is sitting beneath a resistance zone that runs from $87.2 to $89. This is not an arbitrary number drawn on a chart by an analyst looking for something to say. This is a zone where sellers have previously defended their positions, where short interest has historically concentrated, where momentum has stalled in prior attempts to push higher. For silver to move toward $92, the next major structural target, this zone must be cleared, but it cannot be cleared slowly. This is the critical detail that separates a genuine breakout from a false one. Price that enters the 87 to 89 zone and then consolidates inside it does not break out. It invites the exact opposite. It gives short sellers time to reload their positions. It gives hesitant buyers time to reconsider. It allows the zone to absorb the upward pressure rather than surrender to it. What is needed is force. Decisive, unambiguous, aggressive price action that moves through the zone without pausing to negotiate. And the only thing powerful enough to generate that kind of force in tonight's session is a Shanghai Open that doesn't apologize for where it prints. This is where the Monday cash offer re-enters the story, and where its significance becomes impossible to separate from tonight's mechanics. China's scrap buyer offered $96 for physical silver, while Shanghai was still closed. That offer was not placed in a vacuum. It was placed by professionals who had already done the calculation that Western markets were still working through. They had looked at where Western prices were trading. They had assessed where Shanghai would likely open. They had factored in the physical demand waiting on the other side of the holiday closure. And they decided that $96 was not aggressive. It was accurate. If they are right, and these are not the kind of operators who routinely place cash offers at prices they cannot justify, then the 87 to 89 resistance zone that Western technical analysts are currently watching is not a ceiling. It is a speed bump. Consider what a Shanghai gap-up open triggers beyond just the silver price itself. The first domino is COMEX positioning. Traders who are short silver on the Western Futures Exchange suddenly find themselves on the wrong side of an Eastern market that is opened significantly above their entry. They do not wait for confirmation. They cover. And covering short positions in a market that is already moving higher does not slow the move. It accelerates it. The second domino is institutional repricing. Asset managers, commodity funds, and macro traders who have been watching silver approach resistance begin receiving the same signal simultaneously. Shanghai's Open is public information. It cannot be selectively distributed. The moment it prints, every serious participant in the global silver market sees the same number at the same time. Every generation of investors believes their moment is unique. They believe the conditions they are living through have never existed before, that the pressures building in their era are unlike anything that came before them, that the rules which governed previous markets no longer apply, that this time, whatever this time happens to be, is fundamentally different from every other time in history. Most of the time, they are wrong. Markets rhyme, cycles repeat. Human behavior under financial pressure follows patterns so consistent that historians can trace them across centuries without losing the thread. But occasionally, rarely, and with consequences that reshape entire economic eras, they are right. This is one of those moments. To understand why, one must step back from the silver price entirely. Forget the $86 spot price for a moment. Forget the $96 cash offer. Forget the Shanghai Open and the resistance zones and the technical targets. Set all of it aside. Because what is happening in silver right now is not primarily a story about silver. It is a story about the architecture of the global financial system. And that architecture is being quietly, deliberately, and systematically restructured by the eastern half of the world, while the western half is still debating whether the restructuring is even real. For the better part of a century, the United States dollar has served as the world's reserve currency. This arrangement, formalized at Bretton Woods in 1944 and reinforced through decades of geopolitical dominance, gave the United States an extraordinary privilege. It could print money, it could export that money to the world, and the world was obligated to accept it because global trade, particularly in commodities, was priced and settled in dollars. Oil in dollars, copper in dollars, gold in dollars, silver in dollars. The dollar was not just a currency, it was the measuring stick against which all real things were valued. But measuring sticks only work when the people using them agree on the measurement, and that agreement is fracturing. China's behavior in the silver market over the past several years cannot be understood in isolation. It must be read as part of a broader strategic framework that Beijing has been executing with remarkable patience and consistency. China is the world's largest producer of solar panels, and solar panels require silver. It is the world's largest producer of electric vehicles, and electric vehicles require silver. It is aggressively expanding its semiconductor manufacturing capacity, and semiconductors require silver. Every pillar of China's industrial strategy for the next 2 decades runs directly through the silver supply chain. This is not a coincidence. This is a plan. When China's businesses pay $96 for silver while the Western paper market says $86, they are not making an error in judgment. They are operating from a different set of assumptions about where the world is going, and they are positioning themselves accordingly, years before those assumptions become obvious to everyone else. The Western investor looks at silver and sees a commodity. China looks at silver and sees infrastructure. That difference in perspective is worth $10 per ounce today. It may be worth considerably more tomorrow. The de-dollarization story, dismissed for years as the concern of fringe economists and geopolitical alarmists, has moved firmly into mainstream institutional conversation. BRICS nations, which now represent a larger share of global GDP than the G7 on a purchasing power basis, have been actively developing alternative trade settlement mechanisms. Bilateral currency agreements between major economies are accelerating. Central banks around the world have been buying gold at a pace not seen since the 1960s, a period that notably preceded the collapse of the Bretton Woods system itself. Physical commodities, gold, silver, copper, oil, are being accumulated not merely as investment assets, but as strategic reserves, as insurance against a monetary system that a growing number of nations no longer fully trust. Silver sits at the intersection of every one of these forces simultaneously. It is an industrial metal in an era of unprecedented industrial transformation. It is a monetary metal in an era of monetary uncertainty. It is a strategic resource in an era of geopolitical realignment. There is no other asset on the planet that occupies all 3 of those positions at the same time. This is why the Monday cash offer is not simply a market data point. It is a window into how the most sophisticated physical buyers on Earth are currently valuing silver, not based on what a futures contract in New York says it is worth, but based on what it will cost to secure the physical metal needed to execute a decade-long industrial and geopolitical strategy. These buyers are not reacting to prices. They are anticipating them. And the gap between their anticipation and Western market pricing, currently sitting at approximately $10 per ounce, represents one of the clearest signals that serious observers of the global economy have seen in years. For the business community watching these developments, the strategic implication is not complicated. When the world's largest consumer of physical silver begins paying prices that are structurally above what Western paper markets are printing, before a major exchange reopens during a period of acute geopolitical tension against a backdrop of accelerating de-dollarization, the message being sent is not subtle. Physical supply is tighter than the paper price suggests. Eastern demand is stronger than Western analysts acknowledge, and the convergence between what silver costs in the East and what it costs in the West is not a question of if, it is a question of when. History has a consistent record on what happens when paper markets and physical markets diverge significantly for extended periods. The paper market does not pull the physical market down to meet it. The physical market pulls the paper market up. It has happened before. It will happen again. And the professionals, The scrap buyers, the industrial users, the sovereign wealth managers, quietly accumulating real metal through channels that never appear in Western financial media, already know this. They knew it on Monday. They expressed it at $96. Tonight, when Shanghai opens, a new chapter in this story begins to be written. The Western world will watch the opening print. Analysts will comment. Headlines will follow. Retail investors will scramble to understand what they are seeing and whether they have arrived too late. But the serious observer, the one who read the signal before the market confirmed it, will already know the answer because the signal was never hidden. It was sitting in a cash offer, placed quietly. On a Monday morning, while Shanghai slept, $96 from a business